Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, December 13, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So we got the Fed out of the way. As expected, the Federal Reserve, or FOMC, Federal Open Market Committee, raised the Fed funds rate by 25 basis points, or 0.25%. It was expected, it was telegraphed, it's behind us, and that's the end of it. So let's talk about the market. So once again, we have a very similar situation to what we had yesterday. The market tried to make new highs today, did make new highs intraday, but it's not how they trade them during the day that's important. It's where they close them at the close of the day. That's where the important number lies. And what's interesting today is you can see here that the Spider closed at 266.75, and to me that's very telling. What I've done is put a line up here at 266.80. That was the high from the other day. So while we've had a series of higher closes, we haven't been able to close above that high from the 4th of December. So I find that interesting. It seems to be, or appears to be, an important number. We've tried to close above that number. We have yet to close above that number. So today, and I'll switch over to a 10-minute chart, what you'll see is at the end of the day, once again, very similar to yesterday, we had a sell-off into the close, and we closed below that important number of 266.80. And again, 2 days in a row, similar market behavior. That tells me that that number's important to the market, number one. And number two, we're probably likely in for a couple of days of a little bit of selling pressure in the market. That's the way I read this information. I'm not looking for a lot of selling pressure in the market. What I've done is I've moved up the important number that we had down at the 266. What was that number again? 260.76 was the low. We had it at 260.66. I've moved that up to 262.75. I think even if we did get a sell in the market, I'm not even sure we get down to that number. But if we did, that area would be supportive of the market. You see here where the 20-period moving average or home base is trading up into that number or trending up into that level. And that was also a level where the market found support before and likely would find support again. The known knowns that we have are the pending tax bill that's running through Congress right now. There are a series of unknown knowns or known unknowns, whatever that saying is. And there could be a black swan event. Of course, there always could be some geopolitical event. So we don't know what that is. You might wake up one day and North Korea might have fired another missile, but that's kind of in the known camp. We know they're a rogue nation, they're a problem, but I think we have them mainly under control for the time being. I think the leader over there understands that if he steps too far over the line, that Donald Trump would most likely take some action. Obviously, China is the wild card in that discussion. We're looking to China to help us with North Korea, but if they don't help us with North Korea, I think President Trump would do it on his own. I don't think he wants to. I don't think anybody wants to get to that point, but they are a wild card out there. Other than that, between now and the New Year's holiday, in between is the Christmas holiday, volume is going to start to get lighter and lighter as time goes on. And likely scenario is, barring some geopolitical event, the market will most likely not have any large moves in one direction or another. The likely scenario is we're probably in somewhat of a trading range over the next 2 to 3 weeks. All in all, today we did have decent volume in the Spider today, over 100 million shares. Part of that has to do with the fact that there's a lot of jockeying for position in and around the Federal Reserve announcement, and then Janet Yellen had a press conference, her farewell tour, and so there is a pickup in volume on Fed days as a normal course of business. Looking back at the 10-minute chart, there was about 7.5 million shares traded in the last 10-minute candle of the day. That was a down candle. To me, that's another signal or a sign that we may have some downward pressure in the market over the remaining part of this week at least, Remember, it's quadruple witching options expiration week, and therefore, and today, by the way, was Whipsaw Wednesday, and so we did see some ups and we did see some downs, and that's typical for a Whipsaw Wednesday. But all in all, the market really didn't have a big range any way you look at it. When you look at the range today, it was pretty narrow range. So this is indicative of getting into the holiday season. We're unlikely to see large moves in one direction or another, barring some kind of event that hits the tape. Switching over to the IWM had a nice positive day today, up about 0.6%. It was up a lot more earlier, but all in all, can still build a case that this is a bearish pattern. So we have a down move. Here's a wedge, a bearish wedge formation. We may have taken an attempt or tested the high of this red candle today. Didn't quite get there. But until and unless we can close above this red candle, then this will generally promote another down move. How much of a down move is in the cards? I don't think a whole lot. I really don't think, barring some external event, I don't think that we're going to close below this upsloping trend line. And if we do, that's going to be important, and we'll discuss it here, but I don't think that's necessarily in the cards. And what I'm referring to is we can get below there on a daily chart, but I don't think we'll close the month of December below that trend line. If we do, that will be negative for the IWM, and if that happens, we'll obviously discuss it here. Closing above this red candle we just pointed out right up here, that would be positive for the IWM, and that would likely promote more upside behavior in the market. As you know, the IWM is my favorite leading indicator of the market, whether it's on the up or the downside. It's a fantastic market indicator, leading market indicator. Looking at the transports were up 30 points today, 1/3%. Again, just very, very overbought on the transports. I think we're just going to eat some time off the clock and go sideways. That's what I'm favoring. If they break out to the upside, that's fine. I'll have been wrong. But I think they have to come back in toward the 20 moving average or just eat time off the clock to let the 20 moving average come up into price. That's been the story for the last several days. That remains the story in the transports. No new information. If we were to close at a new high, that's a whole different ballgame altogether. The high was 10,504.80. If we do close above that level, then there's more upside coming, but that's really, really extended from home base. The 20-period moving average is home base in all markets. Aside from that, no new real material information in the transports. One market that did get whacked pretty good today was the financial sector. We'll look at the broker-dealer index, and you can see here, that's a nice little reversal candle on the daily chart in the broker-dealer index. And again, this was also a market that's just overextended on the daily chart and just needs to let the 20-period moving average come up into price or eat some time off the clock, go sideways, or come down a little bit into or closer to the 20-period moving average. I think this was more of a sell the or buy the rumor, sell the news event with the Federal Reserve announcement. And if you look at the XLF, you have much of the same routine. The XLF came down today. Again, it's just an overbought condition, and all this is doing is coming down toward home base or going to eat some time off the clock. Nothing more, nothing less. We don't need that line. The financials have been on a tear, and the rumor side of the equation is the Federal Reserve is going to raise interest rates, so the financials rally because as the spread widens between what they can borrow at and what you and I can borrow at, that's profit to the banks, and the 25 basis point increase isn't enough to anybody really. But what happened is today the bond market rallied, sending interest rates down, and that has a negative impact or negative effect for the banks. We'll get to the bond market in a few minutes, but this was a buy the rumor, sell the news event. When the theory is that interest rates are going to rise, and if the theory is or the belief is that they're going to rise across the board, that's positive for banks, because if you and I are spending more money or it costs us more to borrow money, whether it's corporations or individuals, that's positive for the banks. The spread goes right to the bank's bottom line, but it's a buy the rumor, sell the news event, and it was evident today after the Federal Reserve announcement. Gold. We've been discussing gold of late. I thought gold would come down into the 1230 area. 1229 spot 30 was the actual number I was expecting. We got close, but we didn't quite get there. Last night we talked about the fact that we got up or down into the 1230s area, and today we had a nice reversal in gold, and therefore the likely scenario is that the bottom, at least from a temporary perspective, is in for gold, and yesterday probably marks at least a short-term bottom, and there's probably more upside coming. The first target is going to be this red candle high, and the red candle high comes in at 1266 spot 80. We may go sideways for a few days, build some energy to go higher, or we just trade right up into the next level, which is this red candle high. But the bottom from the short-term perspective is likely in for the gold market. I would have liked to see gold come down into my target area and put in a reversal or a trend change signal at that point. We didn't get that. We just got a rally today, and gold was up a nice, healthy $16 at the time I make this video. For the GDX followers, GDX was also up today very, very nicely. We talked about this last couple of days, and GDX was in the mid 21s to 21. I thought that was the level. I would have loved to see 21. We got as low as 21, 27, and we had a tremendous day today, trading right up into the daily chart 20 period moving average, at which point GDX found resistance. Again, another reversal for GDX. Silver chart looks the same as gold, looks the same as GDX. We never got down to the 1550. We had a reversal today. Most likely the short-term low is in for silver, gold, and GDX, and across the board in the mining sector and the metal sector, gold and silver related for now. We knew we were getting close. We just didn't get to the specific levels to the penny that we've been discussing, but we were looking for a reversal. Today was that reversal. Crude oil, on the other hand, is now below the 20-period moving average and showing signs of weakness. Will most likely come down to the area discussed last night, which is this low right here. And that low may coincide, depending on when it happens, with this upsloping trend line, and that would likely provide support for the crude oil market. If that breaks, we have 55 as the next level, and if that doesn't hold, then we need to look all the way down to about 53, 53 and a half in crude oil. That's a little far off from now. Right now, we're looking to just below $56 a barrel, should provide a level of support for crude oil. If we hold that level around 56, then the uptrend really is not broken. As long as we hold above the 50-day moving average, the uptrend stays intact. So we'll watch crude closely over the next few days. I think it's just working off some of this overbought condition. We've been up nicely in crude for quite some time, and I think they're just consolidating to go higher one more time. The bond market. Look where we are in the bond market. Now forget the fact that this is the bond market and just think in terms of a chart. We've been discussing this chart each and every day, and I've been saying that as long as we can get above and close above this red candle high, and that's where this horizontal line comes from, then the bond market has higher prices coming. Now, we closed above it one time and failed. When we did, I said that's the signal that it's likely going higher. I think it was a rope-a-dope. I think we closed above it, came down to fool some people, and here we are, and it just so happens it's on the Fed day when you do get a lot of movement in many different markets, bond market no exception, and therefore, right now, we're trading above that level. So we'll see where the close is, but I still contend that we're going to challenge the double top area right up here, okay, give or take, and we'll refine the number if and when we do move higher in the bond market. But I contend we're going to challenge that area, and we'll see what happens in the short term. But I haven't changed my tune. As long as we can get above this important level, the actual level in the bond market is 153.22. But just look at this line, and once we can close above comfortably this particular level, I think we're headed off to the upside in the bond market with lower yields coming. Long-term picture is bearish. Short-term picture is bullish for bonds. That's the way I see it. Nothing has changed same tune that I've been singing for quite some time in the bond market. I think there's a rally coming. It is interesting. It is a buy the rumor, sell the news. If you think about it, higher bond prices promote lower yields. The Federal Reserve announces they're raising the Fed funds rate, which means, in theory, interest rates over the longer term, meaning the next year or two, in their mind, should be rising. And today is the day we get an increase in bond prices and a decrease in yields. So interest rates are coming down today as the Federal Reserve is raising interest rates. It's an interesting phenomenon. Buy the rumor, sell the news. And here we are in the dollar, another market that moved in and around the Federal Reserve announcement. And you can see here, we closed above the important level one time, very similar to the bond market that we've been looking at for quite some time. And here we are with a pretty decent sell-off in the dollar. So maybe this was a fake out, maybe it's a rope-a-dope. We'll see. We'll see if this 100-period moving average holds. If it doesn't, we're going down in the dollar. If it does, then this was just a pullback and we'll go up for higher prices. We'll see. Not an easy market to trade of late, or for the last year for that matter, in the dollar, but we'll see what happens over the next couple of days. Pretty good sell-off in and around the announcement today from the Fed in the dollar. And with that, it's everything I wanted to and intended to discuss tonight, so I'll give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.